what is corporate governance, guys? It's basically the system by which a company is directed and controlled, right? To put it in very simple terms. And this is where we talk about how the leadership should be structured. The leadership of the business should be structured, like the board of directors, right? There should be a balance of EDs and NEDs, and then chairman and CEO should not be the same person, etc. Moving on to audit committees, right? So there are different subcommittees that we have when it comes to the board of directors. Primarily, we are focusing on audit committee, right? The first thing that we learn is regarding the fundamental principles. Okay, folks. So when it comes to ACCA, there are 5 fundamental principles that you have to learn, right? So when it comes to ethical threats, again we have a mnemonic which is ASSIF, right? Hey everyone, this is Vishnu Vijay, ACCA, a proud FinTrammer who's been teaching students across the globe and across designations. And I welcome you all to this particular session where we will be revising through all the core topics of the audit and assurance paper. But primarily in this video, you'll be looking at the syllabus part A, which is Audit Framework and Regulation. Okay, folks? So let's refresh our memories again regarding this particular syllabus area. So, I'll start the timer and let's get started, shall we? So first of all, there are 4 things that we will be looking at as to what audit and assurance engagement is all about, and then the regulatory framework of audit, and then corporate governance as well as professional ethics as well. Shall we? So let's quickly go through the first topics, right? So first of all, we have external audit. So what is external audit? When we generally say audit, we talk about external audit primarily, right? So what is an external audit? An external audit is basically an engagement where the auditor reviews the financial statements prepared by a company. Okay, folks, what is financial statements? It includes 5 documents, right? What are these 5 documents? The statement of profit and loss and other comprehensive income, the statement of financial position, the statement of changes in equity, the statement of cash flows, as well as the notes to financial statements as well, right? So the auditor reviews all 5 of these documents and provide an independent opinion that they're free from material misstatements, that they provide a true and fair view, and they're confirming, with the applicable financial reporting framework as well. Okay, folks, so this is basically as to what an external audit is, to put it in very simple terms, right? And there are 3 primary objectives of conducting an audit. First of all, as I mentioned earlier, it is to provide, an opinion on the financial statements that it provides a true and fair view. And then we also look at the accounting records, right, which is basically the journals, ledgers, and everything. And we ensure that they're accurate and complete, right? And then we also ensure that they comply with the financial reporting framework as well. Okay, folks, which is the accounting standards. Some organizations follow the IFRS standards, some follow the US GAAP, some follow the Indian standards. There are many other local accounting standards as well, right? Which is why we're using the terminology that is applicable financial reporting framework. Now, the next thing is the fact that external audit is just a subset of assurance engagement, right? Assurance engagement is a broader term, right? It includes the same principles, but it's just that there are different elements to it as well. Okay, folks. So what exactly are the elements of assurance engagement? We have the CREST here, right? CREST. What does CREST stands for? C stands for criteria, right? Which is basically the criteria using which the subject matter is evaluated, as in the financial statement is evaluation, basically accounting standards, right? And then we have report, which is a written report on which the opinion is provided, right? And then we had evidence. And remember, guys, when audit, we always obtain sufficient and appropriate evidence, right? Which is evidence of the right quantity and of the right quality as well, right? And what else? We also have subject matter, which is basically the financial statement itself in the case of an audit, on which all procedures and everything is conducted. And of course, there are 3 parties involved when it comes to an assurance engagement as well. Who are the 3 parties? We have the intended users, which is basically the users of financial statement, the responsible party who is in charge of preparing the subject matter, or in the case of an audit, the financial statements. And then, thirdly, we have the practitioner, who is the one who is providing the opinion, which is basically in the case of an audit, the auditor, right? So these are the 3 parties that are involved. Now, moving on. So when we talk about assurance engagement, there are primarily 3 types that we're learning, right? So first of all, we primarily focus on external audit itself, right? And then we also look at internal audit as well as review engagements as well, right? So what is the difference between external audit and internal audit? In external audit, the auditor has to be independent. They have to be, as the name suggests, external to the company, right? Internal auditors are usually employed by the company, or or their scope of work is totally different as well. I hope they can be employed and of course they can be outsourced as well. But the scope of work is totally different. So when it comes to external audit, we primarily focus on the financial statement and as to whether it provides a true and fair view. Whereas in external audit, they do not only review the financial statements, but they also review internal controls. They provide consulting services. They provide risk management services. They ensure that the corporate governance principles are being followed in the company, etc. So all these things are conducted by internal auditors. Now, moving on to the review engagements, right? These are basically those engagements where we do not provide a reasonable amount of assurance. Because as you all know, reasonable assurance is basically something that we provide in an external audit, right? Whereas in review engagements, it will be limited assurance. Okay, folks. So limited assurance is a less amount of, it's basically a less amount of work as compared to an external audit. And of course, it's, a lesser amount of assurance as compared to reasonable assurance as well. Okay, folks. So remember that. And when we talk about external audit, there are two types, right? There is statutory audits as well as non-statutory audits. Statutory audits is when it is mandatory required by law to conduct an audit. And non-statutory audit is when audit is conducted on a voluntary basis. Okay, focused on mandatory as such. But people still conduct the audit due to its benefits, such as it increases the credibility of the financial statements, right? So that's basically why. Now, what else? True and fair view, right? So one of the primary objective of conducting an audit is to provide a true and fair view. Now, what does true and fair view mean exactly? True means that all the information that is there within the financial statement, it confirms with reality, and it is the actual facts. If that's basically something that we need to ensure. And then we also ensure that the accounting standards and legislations are followed. And of course, the data is correctly transferred from the records to the financial statement. As in, have we correctly transferred the journal entry transactions to the ledgers, to the trial balance, and then to the financial statements. Okay, folks. So that's basically the idea. And then fair means that the information should be clear, impartial, and unbiased. It should not be influenced by anything. And then, it should follow the principle of commercial substance over legal form. Okay, folks, all transactions should be recorded that way. Now, what else? We also have review engagements, right? So as I mentioned earlier, review engagements is where we provide an opinion with less evidence than an audit. Okay, folks, that's basically it. Some examples are given here. We have risk assessment reports, system reliability reports of due diligence reviews, right? These are some examples. But it's not a conclusive list. There are many other review engagements that we conduct, such as review of prospective financial information and stuff like that. So just remember that, okay? And then levels of assurance. There are three levels of assurance majorly. There's the absolute level of assurance, which is 100% guarantee that nothing is wrong, which is not something that the auditors provide. Okay, folks, so just remember that particular point. And we're trying to get there, but we haven't reached there yet. But, so when it comes to external audit, we primarily provide a reasonable assurance. Why? Because we don't have the time or the resources to go through every single transactions of a business, right? So, in order to save time, we may, sample certain items, right? So, therefore, we can only provide a reasonable amount of assurance. So keep that particular point in mind. Which is a high level of assurance. It's still a high level of assurance. And, limited assurance is basically, as I mentioned earlier, it's low to moderate level of assurance, which is less than reasonable amount of assurance. Okay, folks. So I would say that reasonable assurance is around 95%, 95 to 99. Okay, folks, around that teaching, I would say. Now, when we talk about the general principles for an auditor to follow, there are three major principles, right? There's, of course, the ISA standards. It's not just the ISA standards, but any standards published by IAASB, International Audit and Assurance Standards Board. Okay, folks, that's basically something that the auditors should follow to ensure that they provide a high quality services to their clients. And then they have to comply with the ethical standards, right? There are two ethical standards that we primarily focus on throughout the syllabus, right? First of all, there is the ACCA's Code of Ethics and Conduct. And secondly, there is the IDSB standards as well. International Ethical Standards Board released or published standards as well. Okay, folks, so remember that. And then thirdly, we have professional skepticism as well, right? So when it comes to professional skepticism, it involves three things, primarily, right? It involves, having a questioning mindset, being alert to conditions that can indicate fraud or error, and of course, critical assessment of the audit evidence obtained as well. Okay, folks, what else? So, what is the next thing? Benefits and drawback of audit. Everyone knows this, right? So, benefits is that there's high quality information, there's independent verification done by an external party, right? Reduce risk of bias, fraud, etc. Enhance credibility, as well as it highlights control deficiencies as well, right? But when it comes to drawbacks, what all drawbacks are there? even in audit, there are some subjective areas, some accounting estimates which we have to audit, for which we may not be able to provide that much amount of confidence over, right? So that's basically something that's there. And then internal controls may not be relied upon. And then, management representations, would be used as sole evidence in some judgmental areas and stuff like that. We may obtain persuasive rather than conclusive evidence. And of course, sample testing is not exhaustive testing, as in, we're not covering everything, right? So that's basically one of the major drawbacks as well. All right, moving on to the regulatory environment. Okay, folks. So when it comes to regulatory environment, there are three primary regulations which we follow. First of all, there is a national law. In our case, we are following the UK Companies Act, right? And then there's the international standards on auditing as well. And of course, any other audit-related standard published by IAASB, and then Code of Ethics, which is basically the ACCA's Code of Ethics in Conduct as well as the IDSB standards. And then, when we talk about the Companies Act, companies that are listed entities, public companies, as well as banks, insurance, and other financial services, these kinds of companies would require compulsory audit. There's no option to it, right? They have to be audited, right? And then there are certain companies that are exempt as well. Okay, folks. Exempt companies include dormant companies as well as small businesses. In order to meet the criteria of small businesses, you have to have a turnover of not more than 5.6 million pounds. Remember, guys, it's pounds, not dollars. So that's a common mistake that most people make. And then gross assets of 2.8 million pounds as well. Okay, folks. So that's basically the categorization of how you can be categorized as a small or owner-managed business. Okay, folks. And get exemption from audit. And what else? Who has the authority to audit? Authorized firm or individual, or a memberized authorized firm or individual who is hired by or who is authorized by the Secretary of State, or a member of a recognized supervisory body as well. Okay, folks. And what else? Rights and duties of the auditors. So, what all rights do they have? Auditors have access to all the books and records, the right information and they have the right to obtain information and explanations for certain numbers, right? They have the right to attend and speak at general meetings as well, which of matters that are specific to the audit. And then they have a right to receive copies of resolution as well, right? And the duties involve compliance with the legislation, opinion on the truth and they have to provide an opinion on the truth and fairness of the accounts, ensure that adequate records are maintained, agree the accounts to the records as well, consistency of the director's report within the financial statement needs to be reviewed, and the disclosures and disclosure requirements, have they been met or not, right? That's also something that the auditor needs to verify as well. And what else, guys? Appointment, resignation, and removal. How is the auditor appointed? They're appointed to an ordinary resolution by the shareholders. The directors can also appoint them, however, if it's only if it's a first set of auditors, or if it's an audit to fill a casual vacancy. But the final decision still remains with the shareholders. And of course, the Secretary of State. Okay, folks, especially for public companies and stuff like that, the Secretary of State can assign the auditors as well. And resignation involves a step-by-step process. First of all, you have to, send a notice of resignation to the company and regulatory authority. And then you have to send a statement of circumstance, which is an explanation of why you're resigning, to the company, regulatory authority, and to the public, as in, you have to publish it to those people who are entitled to receive a copy of the accounts. Okay, folks, so remember that. And then the request for EGM. Okay, folks, we had the request for an EGM, an extraordinary general meeting, where we explain the circumstances of resignation. Okay, folks, so that's basically how you resign as an audit firm. We're not talking about how an auditor is resigned. We're talking about how an audit firm is resigned. Okay, folks, so remember that. And how exactly can an audit firm be removed? Well, they will be, they might get removed by the client if they have met a certain tenure of, let's say, 7 years, which can, where a familiarity threat can arise, or if the company has expanded so much that the audit firm does not have the necessary resources to conduct the audit. Okay, folks. So these are two situations where, auditors might be removed. And how can they be removed? To an ordinary resolution, just like how they got hired. And then a special notice is set before 28 days. And then we prepare a statement of circumstance as well. Okay, folks. So the company will prepare a statement of circumstance as to why they're getting removed as well. Okay, folks. This is how an auditors are appointed. They resign, and how they get removed as well. Okay, folks. Simple as that. Now, Moving on to the next part, we have corporate governance. What is corporate governance, guys? It's basically the system by which a company is directed and controlled, right? To put it in very simple terms. And it enables the companies to be run in the interest of the shareholders and other stakeholders. And who has the primary responsibility to maintain corporate governance within the company? Is it the auditors? No, it is definitely the directors, board of directors itself, right? So just keep that point in mind. And there are many reasons as to why there shouldn't be poor corporate governance, because poor corporate governance will result in with many corporate scandals like these Enron, WorldCom, etc. Whereas good corporate governance, will enable the company to or prevent the company from falling into such corporate scandals. Okay, folks, so that's basically why. Some basic principles that we learned throughout the sessions would be, the fact that there should be clear roles and responsibilities between the chairman and CEO, right? It cannot be the same person, as per the corporate governance principle. Why exactly is that? It's because, one person should not have unfettered powers. And then, the board should have a balance of executive and non-executive directors. Executive directors are those directors who are involved in the day-to-day routine activities or routine management of the business, whereas non-executive directors are those individuals who are hired by the company for strategic advice and stuff like that, and they're employed on a part-time basis, right? So just keep that particular point in mind. And it is a more independent, okay, folks. So that's also a really important point to keep in mind. And when it comes to the UK Corporate Governance Code, right, there are 5 headings to it, right? So we just have to remember the basic principles behind it as well, right? So what are these 5 headings? First of all, we have a mnemonic CLEAR. Okay, folks, clear. C stands for communication with shareholders, right? So there should be frequent communications happening with the shareholders so that there's no agency problem. An agency problem is basically when the principal, that is the shareholders' interest, and the agent, that is the board of directors' interests, are different. Okay, folks, we cannot have that. Therefore, to align their goals together, there should be frequent connects, such as AGMs and stuff like that. And then we have leadership. And this is where we talk about how the leadership should be structured. The leadership of the business should be structured, like the board of directors, right? There should be a balance of EDs and NEDs, and then chairman and CEO should not be the same person, etc. And then effectiveness. In order for the board to be effective, there should be a balance of skill, knowledge, and experience. And then accountability is the idea that the board of directors will have the primary accountability, or they'll be answerable for the company's position and prospects. And we have remuneration, right? So remuneration is the idea that, remuneration should not be excessive. It should be set at the right level so that we can attract, retain, motivate, and motivate the particular directors to, achieve the objectives of the organization, right? So that's basically the idea. Now, moving on to audit committees, right? So there are different subcommittees that we have when it comes to the board of directors. Primarily, we are focusing on audit committee, right? How should the audit committee be structured? Well, there should be independent, should be comprised of independent non-executive directors, and at least one finance, as in, one of these non-executive directors should have recent and relevant financial experience as well. Okay, folks. So for normal companies, there should be at least 3 NEDs, right? But if it's a small company, then it can be 2. Okay, folks. And then roles and responsibility include financial reporting quality is ensured, and then they can review the internal controls of the organization to see if it's adequate or something like that. And then, or they can, of course, they'll delegate this particular task to the internal auditors, but still. Okay, folks, and what else? Appoint and liaise with external auditors, and then, they can they can ensure that the company has a whistleblowing facility as well, because it's an independent committee, right? So anyone can report any issues if needed. Now, what else? There are other some committees as well, such as the remuneration committee, who's in charge of setting, fair executive pay, and then we have the nomination committee, which ensures that the best people are appointed in the organization, and then there's also a risk committee, where the company's risk assessment is conducted using the TARA framework. For example, TARA framework, as in, we can either transfer the risk, accept the risk, reduce the risk, or avoid the risk, right? So that particular process can be followed. So these are basically the subcommittees. And what else do we have? So how do the auditors report? So guys, when it comes to corporate governance, right? What we do is, like, we do review the annual report. Definitely, the annual report consists of both the financial statements and some other information in relation to the company prospects and everything, right? So as an auditor, even though I don't have the responsibility to audit the other information in the annual report, I will still go through and to identify inconsistencies. Okay, folks? If there is any significant inconsistency, that will be corrected and pointed out to the appropriate level of management. So just remember that particular point. So now we move on to professional ethics. Okay, folks. So when it comes to professional ethics, the first thing that we learn is regarding the fundamental principles. Okay, folks. So when it comes to ACCA, there are 5 fundamental principles that you have to learn, right? So you have to learn about there's a mnemonic that you can memorize it with COPIT. So what does COPIT stands for exactly? C stands for confidentiality, right? And what does confidentiality mean? As an auditor, I cannot disclose any confidential or commercially sensitive information to any external parties outside the auditee. Okay, folks, that's basically the idea. And when it comes to confidentiality, there's also a scenario which we look at where we face a conflict of interest, right? For example, I am, let's say, auditing 2 competitors, right? Company A and Company B, who are competitors with each other. Okay, folks. So then there's a conflict of interest. Which company should I side with, right? So what I'll do is, I'll have my, the first and foremost thing that you need to do is to notify both these clients that I'm auditing their competitors. That's one thing. And we have to obtain consent from both these clients, right? And after obtaining consent, the next step, right? The next step is to use separate teams to conduct the audit. Okay, folks, if it's not a listed entity, then we can definitely use separate teams to conduct the audit. And of course, we have to ensure that there's a Chinese wall. Chinese wall in the sense that each of these separate teams should not share any information with each other. Okay, folks, that's what we mean by creating a Chinese wall. And of course, we make these team members sign confidentiality agreements as well. And we had an independent partner review all the safeguards that we've taken as well. However, if nothing can be done, right? If let's say that the company is not allowing us to, conduct the audit, then we do a commercial judgment, right? For the audit firm, what is more profitable? We retain the bigger client and give away the smaller one. Okay, folks. So that's basically the idea. Now, so that's what confidentiality was all about. And remember, guys, we can disclose. Okay, folks. So we can disclose, confidential or commercially sensitive information if there is a professional or legal duty to do so. Okay, folks. However, we can only do that after seeking legal advice as well. So remember that, right? So these are some of the concepts which we learn under confidentiality. And then O stands for objectivity, right? What does objectivity mean? Your professional judgments should not be influenced by anyone. Okay, folks, that's basically the idea. And then P stands for professional competence and due care, right? Which is basically the idea that your skills and knowledge should be updated so that you can provide high quality services to the clients, and you have a duty to provide high quality services to your clients. Okay, folks, that's basically the idea. Integrity is the idea that you have to be honest and straightforward in all professional relationships. And then professional behavior basically states that your behavior, your action should not disrepute the profession or ACCA in any manner. Okay, folks, so that's basically the idea. So that's what COPIT stands for: confidentiality, objectivity, professional competence and due care, integrity, as well as professional behavior. Now, moving on to the next part, which is ethical threats and safeguards. Okay, folks, so when it comes to ethical threats, again, we have a mnemonic, which is ASSIF, right? So what does ASIF mean? So A means advocacy threat, right? So what is advocacy threat? It's basically when you represent the client in front of a third party. Then what would happen exactly? Well, basically, if I'm, let's say, representing my client in front of the bank for a bank loan, if the company doesn't pay the bank loan, then who's made accountable? The auditors are made accountable, right? So to avoid such a situation, let's not represent the client in front of any third parties. That's what advocacy threat is all about. Secondly, we have self-interest threat. It's basically when the auditors have a financial, business, or any other interest in the client. And then we have self-review threat, which is basically when you, review your own work. If you're reviewing your own work, you won't be independent, right? So that's basically the idea. Let's say, for example, you're, let's say, writing the exam and doing the correction on your own. If you're marking the exam on your own, will you be you giving less marks? I don't think so, right? So that's basically why. Okay, folks, we need an independent person to conduct the marking. And then uh, and then when it comes to intimidation threat, it's basically, giving some psychological pressure to the auditor to complete deadlines and pressurizing them to provide a good opinion. Okay, folks, so that's basically the idea. And then familiarity threat is basically when you have a close relationship with someone in the client, or when your immediate family member. Immediate family member can be parents, your sons or daughters, your spouse, your your siblings, etc. Right? It can also be step siblings or son or daughter as well. Okay, folks. So that's basically the idea. Okay, folks. In such situations, there might be a familiarity threat as well. And of course, there's also some safeguards which we learned about as well. We looked at, like, throughout our sessions, we looked at a lot of example situations, right? So go through those situations once again. Those are highly examinable. So it's best if you understand the laws and stuff like that regarding, or the rules and stuff like that regarding each situation. For example, for situations like glue balling, or a situation where you're given a gift or hospitality, we look at the uh, you know uh, we look at the materiality of the amount and stuff like that, right? Or how significant is the amount and stuff like that, right? So that's basically some situations where you have to go through. Okay, folks. So go through those before the exam as well. And then when we talk about safeguards, there are safeguards implemented at audit firm level that suggest they provide trainings to their staffs, right, about the standards, how to implement the standards, etc. They make them sign independence agreements and stuff like that before the engagement, right? All those things come under audit firm level safeguards. We also have profession and regulatory safeguards, which is basically, the profession provides, as in, let's say ACCA has CBD requirements and the updated examination methods, right? So all those things come under safeguards itself. And then some individual practices, like having a personal mentor, to which you can discuss the ethical dilemmas and how to go about it, right? So all these things can be considered to be safeguards. There are many other safeguards which we discussed in those examples which we looked at throughout the session. So, please go through those one last time before you enter your exam hall. Okay, folks. So yeah, and that's basically it, guys. That's basically all about the key concepts within syllabus part A, audit framework and regulations. I hope you enjoyed it, and I'll see you later in another session where we will discuss some more core topics. Till then, this is Vishnu Vijay signing off.